Boston, and I'm gonna do a steady show. And I know all my fans wanna learn how to make some dough. I've been cruising up and down for trades each and every night. And with my iPhone reclining, I know we're gonna get it just right. I'll get inside your mind, we'll have a real good time. We're gonna trade today, we gotta trade today. Go askSlim.
Hi, I'm Steve Miller. Call me Slim. And this is the askSlim Market Week. A look back at what happened in the markets in the last week, and a look forward at what might happen in the coming week. It's hard to get to this date 9/11 without thinking back and having a solemn moment here, as I can remember that date so clearly. My office at the time at the foot of the Sears Tower, and as I walk in and turn on my TV, there are images that will be forever embedded in my brain. That first tower already burning when I turned it on, and shortly after that, that second plane barreling into the second tower. Thought it was an accident at first, but then quickly knew that things very different had happened, and that 19 Islamist terrorists had attacked the United States, fully intent on killing innocent people. And I don't want to get into a rant right now. I want to think back to that really, really difficult day and the time that followed for all of the people that suffered after that. But you really got to think about this world. Are we safer now in this world than we were then? As we get into the political season, we have to think hard about that. All right, so now let's get into the markets. This has been a week of wide chop. Overnight rallies as markets tried to firm, and then a lot of sellers coming in and rallies really failing. So the market has been acting pretty much as we expected. What we're going to do in this show as well, we're going to take a look at that, and we'll take a look at the economic calendar. Then as we move on, we have some fun things. I've got a interesting word of the week coming, and a lot of your emails to answer, and of course my short-term view of the coming week. So let's take a look at this calendar for the week and look at what happened. What we're looking at really is the background news that has affected the markets. Of course, this has been a holiday shortened week, as we have had only 4 trading days and, of course, Memorial Day close. Interesting, you can see the trading that went on in here in the overnight session Sunday and Monday. So the markets were actually still trading when you look at the futures. Monday comes and you can see, well, we had a strong rally overnight in the markets, and then it pulled back and then had a actual good rally there. We expected the market to actually rally, get up in the S&P 500 cash to over the 1970 to 1984 number. It almost perfectly hit our numbers, and then we expected a pullback. So we did really well again as far as tracking out the patterns that we were looking for. Overnight, what caused that rally on Monday was hope of Tuesday was hope of the Chinese stimulus. China up 3% on really bad data. Exports down 6.1%. Imports, absolute plunge, down 14.3%. And if you want to know if China has been trying to support their stock market, the number comes out. They had spent $236 billion buying stocks to support the market. Everybody figures more Chinese stimulus is coming. FTSE and DAX rally, but the CAC 40 in France actually falls. U.S. stocks were up 2% at noon, and S&Ps end up 43 points on the day. Japan, which actually falls 2.4% on the day, actually has given up the whole years for the gain. Yoku had a giant rally in there, but then we'll talk about that in a little bit. Lost all of that. Regeneron was up strongly on an upgrade. E-Trade Financial did a balance sheet restructuring. And BABA gets a downgrade in the afternoon on slower sales in China and gets a hit. So the stock market ends up strongly on Tuesday. Wednesday, it looked like it was going to be another strong day. As you can see, overnight, another strong rally, but then as the markets open, it gives it up and falls all the way. Huge decline there during the real trading session. Japan that day had this enormous gain, 7.7%, the biggest day in 7 years, as there's some rumblings out there about lowering corporate tax rates. Does that mean they're giving up on their Abenomics, 3 arrows garbage that they've been doing in there? More Keynesian crap? So there's also more speculation on stimulation in China. China up 2%. The Eurozone up pretty strong. That lifts material stocks for the day, some of the best performers. But Netflix has a big rebound of 5% after 6 negative days in there. And oil drillers, well, they get a good pop. Also, Apple up early because of the product event, gives a big downside move. After that, gives that all up, and that helps the market to have that big move to the downside. Thursday comes, and what we get is soft worldwide markets overnight, but China CPI that comes up 2%. And the year-to-date CPI, how about that in there? Down 5.9% year over year in China on their consumer price index. So talk about, they could say that there's no deflation there, but is that real deflation? Year over year, CPI down 5.9%. Lululemon, they beat on earnings. Their comps were really good, but their guidance really disappointed in there. And man, oh man, I'll talk about that later, as they have inventory problems in there. David Tepper, he comes out and he's cautious on the stock market. Larry Summers pleads. I mean, he says, do not raise interest rates because he obviously thinks that we should have 0 interest rates forever. Stocks end up higher in what you can see is a very, very choppy market. Friday comes, and then overnight it's really a quiet session. We're getting into the weekend, but it's a softer market, and everybody's looking towards this meeting for the FOMC Wednesday and Thursday, press conference on Thursday. So we have really flat markets. Our PPI comes out flat, estimated to be up 2%. And the core is up 0.3, but year-over-year PPI is down 0.8%. So again, more whiffs of deflation here in the United States, not like China, but pretty bad. Global equity funds, how about this? Outflows of $46 billion right now, and that is money that's flowing into the bond market, as we've seen a flight to safety bid coming in every time the stock market apparently gets weak. That's a report out of Bank of America Merrill Lynch. Marvell absolutely plunges 17% based on the fact that, well, it warned on earnings and there's an accounting probe going on for them. Goldman Sachs sees $20 oil. And we have the December futures now rolling to the front month. So you can see this gap right in here. That is the roll. And right now fair value is right around minus $11 or $11.50. So that's why we have this gap in the chart, and why you might see some strange numbers when you look up at your screen. So the next thing we want to look at is the economic calendar. And there's, not a lot going on. Again, earnings, very, very few. Federal Express, Oracle, Adobe, those are the ones that I follow that will be reporting earnings this week. And, of course, the big event being coming up on Thursday is the FOMC announcement. Most of the stuff during the week is not really going to move the markets very much. So consumer prices coming out on Wednesday, and the big announcement 2 p.m. Eastern time from the FOMC, and then at 2:30 we'll have Yellen's press conference. Earnings-wise, Wednesday before the opening Federal Express, after the opening Oracle, and then on Thursday after the close, Adobe. So not a lot going on there as far as earnings and big news on Thursday. So we're going to be probably facing markets that are on the quieter side and waiting for that. I'll make some comments later about what I think is going to happen on the Fed day. So that's the opening segment, and we're going to be back in a second with the best of the week. A week with lots of chop as the market's moved up and down in a range. In fact, there's been lots of chop within the chop as the markets dance up and down through a lot of the days. And we've had very, very few stocks that have made really significant moves. Have a few to look at here in the best of the week. First one we're going to look at is Regeneron, REGN. It had a 4% pop on Monday and then continued up, but has not really been able to hold the gains all that well. Here we'll take a look at Regeneron, REGN. Not a stock that's that easily traded, a 500 plus something dollar stock. Here's that big pop that it had here early in the week, but you can see here looking at this weekly, this is in a pretty bad downtrend still. I don't love this stock. I don't really think that there's any great trades in here, but it did have a very, very good up move, one of the best of the week. Take a look here at Goldman Sachs, GS. This stock on Wednesday had a pretty big pop on some favorable comments. This stock, if you look at the left side here, you'll see it made a nice timely bottom in here, and it's in this what I think is the beginning of a rising zone that's be turning green pretty soon. And you could see here that, though, with this big pop that it got in here for a couple days, it came into this resistance zone. So while Goldman Sachs has been one of the best of the week also, tells you how much I'm reaching here to find good stocks, it also is not acting all that well and pretty much stuck in this range between the support at 180 and the resistance up here at 190. And I think you could probably see it stuck in there for a little while yet. CSIQ, that gets its target range raised, CSIQ, to 43. Can you imagine that? The stock trading at 19. CSIQ is one of my favorites. The valuations in here are incredible, but I was saying that when the stock was $10 higher. We've got this wedge going on right over here on the daily. That suggests that it's going to have another move to the downside, but it did have that big pop, and here you can see as it's trying to get up in here, it still looks like it's got some more downside to it also on the weekly. So everything that I seem to be showing in here doesn't really have a good chart at all. Really struggling on a couple of the big moves. E-Trade Financial, they popped up pretty sharply because they're going to have they're doing a balance sheet restructuring that's going to alleviate them of some $4.4 billion in debt. That had a big pop. Again, that's a stock that just looks kind of okay, we'll call it. Yoku, YOKU, had a big move, up 12% on a partnership deal with China Cash, building a new ecosystem there, and the stock gave it up. That's a stock that I have liked, and I actually think that stock under 16 is a buy. I'm having a hard time this week finding anything that I really want to mention as the best of the week to be looking for the long side. As a matter of fact, I got nothing. I think that the markets are going to be chopping around in here and then ultimately move lower, and I can barely find one that I can tell you that I'd be buying this week. That is sadly the best of the week. Well, pretty much as we saw in the best of the week, well, there hasn't been a lot of movement in either direction, so there wasn't a lot of stocks that we could pick out that have had bad times in this holiday shortened week, and there's still a few of them that are worth noting. First one we have to look at is BABA, B-A-B-A. This one got a rare afternoon downgrade on Tuesday, and the stock took a pretty big hit. The stock has been a stock that has been weak anyway. You can see this is a daily chart, and you'll see the slim ribbon turned into negative momentum right here, and it continued to track all the way down through this whole long problem with the Asian markets and the Chinese market especially. So we're one of the few stocks that gotten close to testing those lows of that panic Monday. But here's that bad day right over here as the stock gets a downgrade. And it probably has some more trouble out there after we get some bounce in China, that this thing is going to move down again. We talked about that crumbling margin debt in China in this liquidation phase, and BABA will not escape that. So we'll look for continued weakness here in BABA. Probably late for me to be very aggressive seller in that one. Next one we're going to look at, well, this was one of our favorites for the downside a couple weeks ago. Got some people write me how well they got paid on this one, and that is Dollar Tree, DLTR. This one we had a nice looking big huge downside gap, an attempted rally in what was a bear flag that formed, and then Credit Suisse comes out and downgrades the stock on Thursday, so that one gets a big hit to the downside. Easily a great candidate for worst of the week last week and worst of the week this week. Similar patterns occurred. We're going to stay on the weeklies in here, on the dailies. In Wynn and Las Vegas Sands. Here's the Wynn chart, and then you could see this stock has been getting buried on the downside. Another one that China is affecting. There's the bear flag, and it moves down sharply. A similar pattern, similar but different, in LVS, as this has been a horrible one and then gets a little bit of a bounce. And here you could see an engulfing pattern at the top of a bear wedge, and it breaks down. So we're going to look for a move down to 44 in this stock, as that one looks really crummy. The winner of the week, of the worst of the week, has to go to Lululemon. LULU. Man, you wouldn't know that by the earnings report. In fact, the stock was up after hours based on its earnings report as earnings came out with a slight beat. Same source sales up 6%. Wow, that was good, right? Inventories, crazy growth in there as they are just overloaded with stock. That really has everybody scared. Why would that matter, right? Well, because they have all that stock, they're going to have to take markdowns to get rid of it, most likely. And the investors don't like what that smells like. And Lululemon, well, that got absolutely crushed. Lululemon, interestingly, let's take a look at the weekly chart, was on my list of best 15 stocks for this year. And it has spent the good portion of the year up for the year, and 10, 12, 16% at times. Here's that Lululemon weekly chart, and this is following weekly patterns actually pretty nicely. We'll take a look at the rhythmic pattern in here. You can see the buying and selling. There's the low lining up right in here, and the buying and failure, and that sets up this decline right into this timing that we had right here. This the fact that it got down this far, tried to rally, and then broke again, that is not a good pattern in here. It had, look at these sell signals in here, the evening star that we had labeled for you right in there, and then back earlier this week, a perfect evening star again, a bigger pattern, and then of course the massive downside break on huge volume. When you get this, you usually get a rebound. I wouldn't buy this stock because it's just too scary looking at this, but I wouldn't be surprised to see it move up to, well, at least a 32% retracement to the upside. What would that be in here? Let's just grab the Fibonacci retracements and bring it down to this level here where it traded down to. So I don't know, could it see 58, a $5 bounce in there sometime in the next few weeks? It's possible, but I'm not making that trade. This definitely is the winner of the worst stock of the week, and that inventories is a scary situation. If you get some kind of a rebound, it'll probably make some sort of a consolidation pattern, then the stock is likely to head down again. So buyers beware, rallies probably won't last that long in there. Now, in this market where we've seen these gyrations this week, as it is in a correction, yeah, it's in a correction to the upside after the big decline we had. Likelihood is going to be that, well, it could still chop around for a while and probably make some higher ground. But the overall, the risk is really to the downside, and very few, good stocks popping up for me to buy. There are a lot of stocks popping up in sell areas, and I think that with a little patience and waiting for proper entries, you can get some good sales off on some of these stocks. I'm just going to name 6 of them right here that are candidates. For me, again, I want to wait for times when they're popping up because this market keeps popping and failing. Abercrombie A&F, it's got a perfect evening star in there. It's not a bad overall intermediate pattern. I think that one's going to pull back. So that's the best of the worst 6. The other ones that I think have got good downside in them: Lockheed Martin, LMT, Federal Express, FTX. IBM, I think it's going down under 120. I've been really negative on it, and it's been right spot on, and it's been more than a year that I've been saying that. So IBM, I think it's got a lot of risk here in a pattern that looks bad. Costco, it came up to a really perfect sell area. I think that one's got a lot of downside, COST. And this other one that I talked about back quite a number of weeks ago that I thought had reached a level of craziness, Skechers, it just absolutely went crazy in the upside. To me, it's just one of these one product wonders. I've seen these shoe companies come apart. Yes, Nike is an exception to that. LA Gear a lot of years ago went from like 80 to 0. And I'm not telling you Skechers is going to 0, but this one has got no pop left in it at all. Market's trying to move up. There are sellers standing over this one. So I think Skechers has a lot of risk in it still to the downside. And that was a more exciting worst of the week. Margin. That's borrowed money to buy stocks or futures. Probably most of us that are active traders have margin accounts. But way back, there used to be a big stigma about buying stocks on margin. Well, that's a result of, the big party that started after the Depression of 1920-21. Yep, that was a depression back then that lasted all the way through, the crash in 29. Was a big result of the Federal Reserve. They were stimulating like crazy back then in that 8-year period. And of course, you could buy stock on 10% margin. Yep, 90% of what you use to buy stocks, you could just borrow. And they were just pyramiding up stocks as they were moving up and up and up. Of course, that party ended, and so did all of the easy restrictions around buying stock on margin. As the Federal Reserve clamped down on it, it got much, much harder to do during that period. Then over the years, it did then loosen up, and the Federal Reserve, they have played with it a bit, tried to stimulate by easing margin requirements many, many years ago. But now for decades, we've really been at 50% margin. As far as the commodity markets go, they have a different situation. The margins there are much smaller, actually, in relationship to stocks, and maintenance margins can be pretty tight. In other words, if you start losing money on a commodity, they'll be after you pretty quickly, and with a margin call there. But they do move around minimum margin requirements a lot. If in the case that there's a lot of upward movement on high volume in a particular commodity, they'll tighten up margin requirements, try to slow down the speculation. They're always trying to manage those speculators. And the opposite, if something has been going down for a long time, the price of it gets lower, they'll lower the amount of margin requirement, and that might attract some speculators in there. So stabilize the market in that case. During these decades at 50% margin on stocks, that really hasn't negatively affected the stock market. There's been plenty of margin buyers out there. We're going to look at a few slides right here, and you can get the idea of how margins have really been affecting the markets here. First slide we're going to look at is margin debt in the S&P 500, and there you can see that, well, this is really a great looking chart, and you can really see what has happened in here. The red line you're looking at in there is margin debt. We're looking in here from 1995 to 2015, 20 years. The grayed areas are the recessions, and you can plainly see that, well, margin debt and the S&P 500, the blue line, have simply gone up together. As margin debt increases and goes up, as happened through 2000, then all of a sudden they prick that bubble and it starts to come down again. Margin debt goes up with the market and down again and up with the market to 2015, 2 new records. Man, that is a little scary. What does that tell you is coming pretty soon? So yep, we made records in 2015. Now you might say, okay, we have an economy that is growing, GDP is higher, so you'd expect margin debt to be higher. If you want to make that case, let's take a look at the percentage compared to GDP, and you'll see that right here as I bring this up. Margin debt as a percentage of GDP. That is showing you that, well, we're almost up to the record as a percentage wise, and this source marks this off at extremely dangerous levels. That's when margin debt is in relation to GDP is so high that you would expect liquidation phases to come, and you can see whoops, something's missing there, right? Well, who knows, that might be coming soon as we have a stock market that is starting to come down. So you can also look at these things in relation to credit balances. So let's look at the comparison of credit balances compared to the S&P 500. This is a brilliant chart that was put up here, because simply what they did was they said, let's invert the S&P 500 and compare that to, well, credit balances. When credit balances are high, they're green, you can see, and so the inverted S&P 500, in fact, that's where it fell to. That's really neat. People start to accumulate lots of cash. You could see here in 2007, 2008, 09, as the stock market plunged, remember this is inverted, people built lots of cash. What happens is that, well, when the stock market goes up and goes up a lot, this is the rally up to 2000, this is the rally up to 2007, and this is the rally through 2015. What happens is they spend all their money, and when this gets red and real red, it means that were there to be margin calls, where's the money going to come from to pay the margin calls? They don't have free credit balances because they've spent it all. So there's no money in the brokerage accounts to pay margin calls. Guess what happens? You get big, deep downside declines in the stock market because they have to raise cash so quickly. Next one we're going to look at is margin debt. Is margin debt as a percentage of the float in the U.S. and in China. Well, would you look at this? We have the U.S., which a percentage of free float gets up to 3%. That is a lot, a real lot. And what happens then? Well, you get markets that move down because, well, the percentage of float is high. Look at China. This is why, now this is up till May or June of this year, before really the market came apart in China. Look at this, 8.5% of the float. You talk about crazy stimulation that has gone on there. U.S. and China both have had their markets move up very, very strongly. Of course, they're trying to make us feel rich. That's what the Federal Reserve is trying to do. And of course, that's what China's trying to do, move their people out of the lower class into the middle class, grow it. They've done it. They've done it by false growth, building malls that nobody has stores in and condos that nobody lives in. In the United States, of course, not at that extreme, but China has led the way in the equity markets on the downside. And the question is, has the liquidation started in China as far as these outrageous margin debt balances go? Of course, here is the next chart, and this is what's happened to margin debt right now. Thanks Zero Hedge for putting up this. There has been a massive downturn in the margin debt, and that is probably just the beginning of that as far as the liquidation goes. They built their margin debt up to extreme levels over the last couple of years, and that was just probably really the first leg. We're looking for a bounce in the China market coming up pretty soon, but how long can it last? They have more liquidation to go. Are you leveraged up? Not me. Margin. That's our word of the week. I really have enjoyed the emails that have been coming in this week. Of course, that's what happens when I'm reading the charts well. Everything is going good. People are making money, and the emails are really sweet. I don't like it when it goes the other way, when I'm not reading them that well, and these emails, well, they get sour. But this has been a good week. BG writes me, he says, great shows. He says, you talk about using the 1389 bar moving averages on charts. Which ones? Could you explain that? Yeah, I'll do that. I use 13 and 89 on my daily charts. 89-day is a good indicator of a strong support resistance area of direction. And the 13 is a much faster one, of course, and that gives you a good sense also for the same thing. Often when the 13 is rising above a rising 89, you've got a pretty strong situation. And then when it crosses over on the downside, there is a message there. So when it shows up on my charts, I use the Slim Ribbon, which is you can actually download the Slim Ribbon onto your own charts just by going to our resources. The script for it is right there on our website. And what that is a 8, 13, 21 bar exponential moving averages, and it's got little arrows in it that tell you when momentum is up and momentum is down. Not buy and sell signals, but momentum signals. So really like that. The middle one, I keep a little thicker line. That's the 13 day on that. So you'll recognize that when you look at my charts. 1389 on the daily charts or the Slim Ribbon. On the weekly charts, I use 1334. These are simple moving averages also. Same thing on the daily, simple. And same reason, 1334 often a good set for seeing the configuration, whether they're rising or falling, and good support resistance areas also when they set up in support resistance zones that we put on the charts. So I like 1334 simple on the weekly. If I'm looking at long-term weekly analysis, like 5 years or longer, I like this other pair. It's a 2134 exponential moving average. Those are really tight, and it's hard to get them to cross unless there's a trend setting in place. If you look at that, you'll see it on a long-term chart how good that is. I've showed that a lot recently. Intraday charts, I don't use a lot of moving averages actually. I'm okay with moving averages, especially the Slim Ribbon. I think it's a good momentum indicator. I prefer to use them only on 2-hour and 1-hour charts, and then use other indicators on shorter charts than that. Mobile bands, mobile breakout bands, TRIX, TRIX, and stochastics momentum, other oscillators that I think are good for shorter term charts. So that's it on the moving averages. Have an email from MH. We have been discussing cycle analysis back and forth, and he said it's spooky stuff when you have coincidental news coming out at points when there are cycle turns on the charts. I gotta tell you, I really think that it's really the other way around. It's that when markets are really strong, the momentum is up, we're in a rising cyclical phase, bad news, well, it often doesn't affect it very much. And you might get a blip on the downside in markets, but before you know it, they're moving to the upside again. Opposite happens when markets are moving down. Then you get some news out that's good news, well, it can't hold a rally for very long, and they start to move to the downside again. Often at turning points when we expect a market to move to the upside off of a low, some news will come out and affect it very, very favorably, and they'll be off to the races on the upside. Got to tell you, though, it's not the news, it's the cycle patterns. And cycle patterns are just a picture of money flow. We get to look at these pictures, and it gives us a sense for money flowing in the market, money flowing out of the market. So, I like to refer to it as cycle patterns, cycle charts, but it's really money flow, and it's a great way for us to get this look and feel of the market. Got an email from NW. This is kind of a fun one for me. He wants to short United Airlines UAL and Southwest Airlines LUV. And here's the way he described it. He says, I want to do that in this next rally as the stocks in the market move up, which has been happening. We're in a choppy market now off of our lows. And then he says he would use call spreads, defined risk spreads, diagonals that have defined risk in making those trades. Wants to know if I would trade it or fade it. Trade it or fade it, a great segment, was extremely popular when I was on Tasty Trade, and that I wish I could bring it back if I had the staff and the ability to answer and screen calls like I did then, because, well, everybody loved that segment. So I'm going to make believe this is a trade it or fade it question for you. So you want to short United Airlines and Southwest Airlines. Let's just talk about the airlines for a second. They had a big move down when we had that Monday flash crash where everything moved down so quickly and then recovered. JetBlue, Alaska Air, Ryanair, they have all moved to new highs now. So that speaks for something about the condition of the whole market. United Airlines, Southwest Airlines, they have also had some pretty good bounces. Spirit Airlines and Copa, they are, we'll call them, well, they got their wings clipped and they don't seem to be able to tick up much at all. Virgin, I love that one. I think it's a long-term hold. But let's talk about the two that you asked me about, United Airlines and Southwest Air. You want to short them with call spreads in this next rally. Let's take a look at the chart here, and we'll see whether or not, well, what do we see in these charts, and if I like that trade or not. So here is the look at United Airlines, and this stock here looks to me like, well, it has gotten up into this resistance zone. You can see all of these attempts on this weekly chart, like 6 weeks to get up there, and it has not been able to get through that level. Here's that little flash crash, that craziness on that day. If you take it out of there and say that, well, that doesn't really fit in anything going on here, this is really what you have going on in the stock with a corrective period due right in here. So I actually like your thought on this. Where if it got up a little bit more in here, it would be the right entry to short the stock. For a trade, now the bigger patterns in here may be good because, well, the group seems to be getting bought. And don't forget that we have extremely low oil prices, and they really benefit from it. So earnings going forward could be good. Look at this chart. Well, it looks a lot like the one I just showed you on United Airlines. You're picking out a couple that did not make a new high and that are coming up into resistance areas. I like that you did that. So this is the same kind of a pattern that you could see right in here. Let's give it the benefit of the doubt to something like this. I actually do think that these stocks, if they did get a move up into those resistance areas a little more, that you'll make some money, because I think the stock market's going to take them down, because I think there's another leg coming on the downside in there, and so I'm with you on that. You asked me if I trade it or fade it. Well, as far as the longer term goes, well, I wouldn't be excited about it, but for the shorter intermediate term, based on the way you're going to approach it and the timing of the trades, I'm going to trade it. I say that's a good trade. So thanks for that, and thanks for helping me get back to that trade it or fade it revival, which I wish I could be doing, as I said. KC writes me, asked me about 3 different stocks, and I'm actually going to bring those all up. For Sandisk, Gilead, and Apple, Casey sent me his versions of the weekly charts, daily charts, does cycle analysis, and I love getting that stuff, because then I can look and compare, see what you're doing, see what I'm doing, and sometimes people send me cycle charts that are way different than the ones I have, and I say, wow, those are good, and maybe mine isn't right. So then I redo them, and usually put their name on the chart and give them credit for it when I do that. So let's take a look at Sandisk and Gilead. He said he likes both as shorts at the end of the current up phase. Now you can tell that people are listening to me here, because I always want to use the market momentum, the movement, the wiggles to put me in these trades. When I do that, then it gives me less of a probability of getting stopped out, in other words, losing my maximum amount of trade, amount of loss, if it goes against me. And then, of course, less of a possibility of triggering me emotionally because I've lost the money. So that's an important aspect of improving your entries and exits, because of wanting to, well, prevent the emotional triggers. Man, I like to talk a lot about that. And we're going to have Mercedes on again pretty soon, and we're going to talk about just that subject. So we're going to look at Sandisk, SNDK, and Gilead, GILD, two very, very different groups. Sandisk being a tech stock. This Sandisk is a stock that was listed on my riskiest, the riskiest 18 stocks for the year. I have some out there that aren't as good at calls as this one, but when I saw the pattern shaping up in here of the massive double top back over here towards the end of the year, and then saw it starting to break down, well, I knew there was trouble, and I got lucky because like early in January we had the big downside gap. But ever since then, you can see it's been in this kind of trouble. So take a look at the cyclical patterns in here, and you'll see the downward stair-step movement, the rally and the sell-off to a lower low, the rally and the sell-off to a lower low, the same and the same, and this looks like it has out into October before the low is made. This was that extreme Monday down there, so it might not get down to that low, but the energetic motion you can see is still on the downside. It's come back up to this 13, there's that resistance, the 13 moving average, 13 week right there, and you can also see the Hull moving average, a good momentum indicator, still moving down, and purple color, which is negative. So all of that says Sandisk is likely a good sale in the next rally. Good one. The next one you said was Gilead, G-I-L-D. You know, this is a stock that people love, just absolutely love, based on, well, their drug backlog. This is a biotech. Now, again, we have all of these skewed charts because of that really panicky Monday, but still you could see the pattern in here. Now, what's interesting is that if you look on the bottom, you can see the IBB cycle, that is the biotech index, that called for a low right here, and you could see that came about pretty much on time. So then, but if you look here at the Gilead cycle, that calls for a low in October. So we're going to look for another move to the downside. You could see the resistance zone right there. We put that in all of our charts that we look at on a regular basis, in case you're not a subscriber to Slim Charts. And so that's also in an area that it looks like it's going to move down pretty soon. So that I think was good analysis by you, and I think that those trades with patience of getting in a good entry and letting the market then settle back, as I think it's going to do in some sharp way, I think you're going to get paid on that. Also, you sent me charts on Apple, and you on this one also said you wanted to move to the short side on this one. I essentially looked at the analysis and gave you the range that I thought the stock was going to trade in and where the support and resistance was. So let's look at that. Your cycle charts were exactly as mine were, and I thought that that was great. I have one extra cycle on my chart that you don't have in yours, but it's still lining up pretty well. Let's take a look at this weekly chart right over here, and you will see Apple getting up into this resistance zone. Now, the way these cyclical patterns line up, what it suggests is that the period of decline right in here is going to get it back down pretty significant levels down here. And the support coming in here at 104, I think, is a big support. The resistance right in here, 117, sorry, is the bottom of that range, and you can see it's kind of struggling in that area right now. So this looks to me like we are getting very, very close to that entry level. Now, of course, on the daily, now these are the, this is a little different kind of analysis I have in here. It shows where the nested corrective phases are, and those usually bring pretty good sized declines. This one you can see right in here, and this one came really early. It gets into that zone, but it looks to me like, well, there's likely to be more action on the downside. There's that 104 support coming in right over here. You could see the support and resistance zone. So I actually do think that Apple is in an area where it can be sold for trades. Market could still carry it up a little bit if it keeps bouncing, but I wouldn't be surprised to see 104 again before the early part of October in Apple. So I think that I'm in line with your thinking on those. Next one we're going to look at, I get a tweet from Raj1219, wants to know about CVX. He says, your thoughts on that? It's underperforming compared to Exxon and ConocoPhillips, XOM and COP. You know, I'm going to look at that one here. It did dip into support just as these other ones were getting stronger. And CVX is the one that you're looking at. Let's put that chart up, and you'll see that it has come down to the support area. This is the 78% retracement here that you could see on the daily. We'll go to the weekly. I think it's a little clearer look. So this looks to me like a bull flag going on here. I think any uptick in oil, and you'll get this stock. Whoop, didn't want to do that. Here's your bull flag forming right in here. You could see that. And I think that any uptick in oil, you'll get this popping up here, potentially back up to this other area in the low 80 area. So let's take a look here at the weekly. And you'll see, well, this one is really late in an upturn. It made this big down move and then came all the way back up. This is very, very likely to get another move on the upside, as I think we're in these rising phases on these cycles. They just got late starts in here. And you can see this monthly 61.8%, almost a perfect touch on there. We have to go back to monthly charts on some of these because these lows are so deep, but we do want to have all those supports and resistances for you. So that was a perfect touch. I actually think CVX is going to catch up and have a move to the upside. Just a little pop in oil will probably get that one moving. TM writes me, he says, just checking, on 825 you did a big picture stock market analysis, and has that changed? That analysis, without giving you too much, without becoming a member, to see that was negative. And has it changed? No, it hasn't. AN writes me, we've had a back and forth discussion about trading the markets, and he asks, actually a really good question. I wonder, with so many stocks that have really good fundamentals, down like 25-30%, and even more, if the market goes lower, would you expect those stocks that have these good values to continue to decline? Well, it's a two-part answer that I have there. The first part is the fundamentals are deceptive. Everybody measures against a particular PE, and the PEs right now are created by ZIRP, zero interest rate policy. So in other words, the earnings part of the PE is inflated. That makes the earnings number lower. So if we were back at some normalized interest rates and these companies were paying a normalized amount of interest, right now they pay interest of like an S&P, an average of $1.50 a share, where they used to pay $4 a share in interest expenses. That would really, really negatively affect the valuations. PEs would surge based on the reality of what the earnings portion of that is. So I think earnings plainly are fake. I did a piece on that you can find on, I think on YouTube and definitely on my site, regarding the false valuations of the stock market. The other part of the answer is that we're in a deflationary environment. My discussion about margins today in this show talk about how there's a collapse going on in the credit expansion of buying stocks in China and how that's set up here in the United States. When you get into these environments, it doesn't matter what the value of the stock is. When they have to sell, they have to sell. They have to raise money. And that's a deflationary environment. You know, people talk about deflation, which, well, we really don't have, right? But there's a big difference between that and deflationary environments, which I think we are solidly locked into all around the world. Last question, RJ writes me, he said, you said we're going to have a 5 or 8 day bounce in the stock market. Is that trading days? And when did that actually begin? Well, actually, they are trading days. I always talk about trading days in the market. And that actually began about 6 days ago. And we have had that bounce. And you want to know what else is coming up? You're going to have to see my short-term view. And that's coming right up.
Hi, I'm Epiphany, the askSlim spokesperson. Thanks for watching our weekly show, the askSlim Market Week. Grow your analytical skills, strategies, and confidence when you watch videos from these 6 categories in our member area. Futures Speak, in-depth analysis of 24 commodities and index features. Tools for Techs, featuring how-tos on many charting tools, often highlighting current trading and investment opportunities. Trader Psychology, in which Slim brings a holistic approach to trading, looking at many personal issues that can be obstacles to success. Stock Sectors, a look at stock groups and ETFs that may offer present opportunities. IRA MO, with ideas for longer-term approaches to your self-directed retirement accounts. Big Picture Analysis, a broader view of the major markets, with perspectives on important tops or bottoms, or ongoing, longer-term momentum. So don't miss these great videos. Raise your probability of success by becoming a Level 2 member at www.askslim.com/membership.
All right, this is our short-term view of the coming week. We always take an accountability of how we did in the previous week and then look at this 4 to 7 day period looking forward in the 5 different markets that we follow. Markets last week, well, really followed pretty closely. 70 to 75% is what we're going to give ourselves for the last week. We had stocks, bonds, the euro, oil moving just about in the directions that we expected. Bonds not quite in the duration that we were looking for. But overall, I would say, really good week. And now we're coming up to this next week where we have the FOMC meeting on Thursday. It's Wednesday, Thursday. We'll get the announcement on Thursday. And that it could be a big move. I'm actually strongly believing that they want to start this increases in rates, get that trend going and see how the markets react. I'm thinking that the stock market will rally and maybe rally strongly briefly if they do raise rates. I don't know if other people are thinking that, but to me it's like, wow, a sigh of relief. We finally got this out of the way, and so I'm kind of looking for that to happen. Kind of a choppier sideways week for the stock market. And then that blip to the upside that I think will fail and set up the next big decline I think that's coming in the stock market. So let's take a look at these charts and take a look at how these patterns are setting up, what I was looking at in the last week and what we're looking at in the next week. Here is light crude where we're going to start. We were looking for a choppy range with a small change. And you can see the choppy range with the small change right in here. That's pretty much what we got. Now, you can see the projection in here as we have, we're looking at 2 cycles when we look at this. We look at this big one right in here that you could see trading, and putting pressure out here into late September. And the smaller one in here, which has a repeating, actually, mostly like an average of 8 or 9 days. Occasionally you get a 7 and occasionally you get a 10 that you see there. So the way this pattern is looking is like this right in here. We're going to look for some small down into the beginning of the week, and potentially dip we're going to look for around 43.40. That's the support number that it tested during the last week. Maybe dip a little bit under that, and then when this cycle takes over, begin to move up again like that. So Goldman Sachs, they come out and say $20 oil. They came out and said that on Friday, so maybe that's putting some pressure on the oil market today as it's down to almost 3%. Down $1.32 on Friday, but as we said, we don't think it's going to go that much lower in here, just under maybe 43, and then try to get a rally again. So I make little notes with little arrows on my sheets when before I do the show, and so my note looks like this. That's what I'm looking at that kind of action, so that is a look at light crude. Next thing we're going to look at is gold /GC. So while I was right on oil, I was not right. This is the one I would say I really got wrong in gold. Gold, I said last week, a small up week. Well, we don't see that at all. As a matter of fact, what I was looking at was that it would hold like in this area, get this little rally in here a little stronger, give us the small up week, and then turn down. That's this cycle here. Well, the action is weaker than I expected, so I was making kind of a little counter trend call on the short term, and that didn't work. I should really stick with the trends as I see them in here. And this now, the little arrows I drew on my notes right now, what they look like is like this. So it's like down into the end of the week and then move up. So this is kind of the pattern we're looking at. We're going to call it a sloppy small down week in oil with a potential for a recovery late in the week. All that sets up for, if we get that pattern, that this weakness shows up through end of September, beginning of October. So we're just looking for some downward chopping here in gold. Did I say oil? In gold. Looking for this week to be, we'll just call it sloppy small down with a possibility of a late week recovery. So that is a look at gold, which we got wrong last week. /6E is the euro currency. And this pattern in here, you can see now the pattern that we were looking for. I never go to the weekly in here. I pretty much save that for the people that are subscribers, but I do want to go to the weekly. The reason is because I said there was an inverted hammer last week that said to me the long trade I was looking for in the euro was likely to work. That's this pattern right in here, and you can see that we got the rally for the weekend there. So that's what tipped me off to the fact that we were going to get an up week. That certainly we got. I expected it to get up to 114. It fell short of that. It missed it by about a half a penny, but we did get the up week that we were expecting. So what does this look like now? Well, it looks like this is going to roll over, and this is the opposite of what I see in the dollar right now, of course, that we're likely to get rolling over by mid or late week, and if we have that, we have a shorting opportunity essentially between 113.5 and 114 for really short-term traders. I think that there's a pretty good possibility that in the next 1 to 2 weeks, in this declining period right here, that it gets down close to 111. And the dollar pattern is exactly opposite of this, where it looks for a bottoming and then a rally. Excuse me. So that's why this is setting up where I was bullish last week for a rally. Now I think that 113.5 to 114 area is a short side entry, and we get a trade to the downside. We're going to call it rolling over, and then by midweek getting that shorting opportunity, and then coming down for into the next week or the following week after that. So that is a look at the euro currency. Next thing we're going to look at is the bond market. And I didn't get that correct, /ZN, as we're going to stay in the 10-year to look at this. And let's, this is a really incredibly busy chart. I've got so much information on here. Let's get a closer look to what we're looking at in here. Now, last week I said that there was risk of big down, that it would be a down week. Well, it was a down week, even though we have an up day on Friday. However, not a big down week, and we're in this period where there is considerable downside risk. I'm only giving myself half credit for this because it is down for the week, but certainly doesn't give the kind of decline that I expected. I believe that if the stock market can hold up and we get this upward movement around the Fed day, that might be the time period where the bond market has the big hit to the downside. Still looking for a significant downside move. It is getting late, and I'm going to have to reevaluate these intermediate patterns if we don't start to get this move in the next 1 or 2 weeks. So we're in that period now where the risk is very high, and the patterns do suggest that we're going to hit targets down in the 10-year at 125.02. Which is the support that comes in right over here, or the measurement of 124.09, which is this head and shoulders pattern that's forming right in here that didn't break down yet. You can see how it held in there. So this pattern to me certainly suggests that the risks are high right now for a big decline. And if it doesn't break this neckline in the next week, then I have to seriously reevaluate this picture. And I'm certainly willing to do that, but I'm going to call these risks high, and that the risks are that we're going to get some serious selling coming in this next week. And you can see here on the weekly here how this big pattern is pointing down in here, and it has brought selling in, but certainly not the selling that I expected and hoped for in the bond market over that period of time. So that's a look at the first 5 markets that we're going to look at. Now, as I'm saying, that there's big risk in the bond market, I think that the stock market for the next week is going to be okay. Originally, I had talked about this 5 to 8 day period that I thought the stock market would rally for, and it's kind of an upside correction that we're looking at. And that we've been in that now, and it still looks to me like we're in that range. So we thought that the S&P 500 SPX would have a rally up to the 1970 to 1984 number in this week, and we were spot on in that call. Here is the chart here, and it's been following our patterns just fantastically as we've had this great rebound twice actually off of this depressed low. We had 1 rebound and 2 rebounds, and that's what we were really looking for. Now this is the 5th day high. We said 5 to 8 days, so we're now 7 days off of that low. We have the FOMC coming, and I really get a sense that there's a possibility in this coming week that this support zone is going to hold, and that right around 1930-ish is where that starts, and that we're going to get another pop to the upside. So while I'm looking for bonds to have a big drop, I'm kind of looking for one more move to the upside in here, where it trades up back to this 1984 number, and potentially in some craziness 2012. That would be craziness if it got there. Either way, this is a big sell zone, 1984 to this 2020, because then the probabilities are strong of a big decline. We're going to call this week quieter into the Fed, holding and then having that rally, and then after that the risks mounting. So this looks like an up week to us coming up, and just the inverse of what we're expecting in the bond market. Let's take a look at the VIX, VIX. And this is pretty supportive of what we were thinking about as far as the VIX pattern. Now, we expected the VIX last week to have a small downward bias, and you could see that in here because we thought the stock market would have a small upward bias. And we have thought the support would be in the low 20s, and that's kind of where it's been. So this next week that we're looking at looks like a choppy bunch of movement in here. We're going to call a 21 to 27 VIX over the next week. And that if it gets down to that, under 22, 21 area, I think buying implied volatility is the right thing to do at that point, because I think that after that rally to 1984 to 2012, if I am right and we do get that the stock market is going to have a major hit again, and that we're going to see VIX move sharply higher in this pattern. You can see that right over here. So all of that, I'm trying to extrapolate from these patterns in here what I see, and what I see is weakness for the bonds and firmness for the stocks into this Fed meeting and maybe a day or two beyond, and then after that a reversal. And it's kind of a bold call because right now bonds are absolutely firm and stock market is definitely soft. That's it. That is our short-term view of the coming week. I, as always, hope you have loved this show. Please write me, send me your comments, criticisms to slim at askSlim.com. Members, you can just click on Email Slim right in your dashboard. And don't forget to tell everybody about our show, because we really want to grow this, and it's up to you to spread the word. I'm doing the best I can and working hard at all of these great videos. Hoping you have a great, profitable week coming up, and I'm going to see you next week, and I'm always wishing you great trading.
Well, I'm going to the city and I'm going to do a city.